Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. David Pollio, welcome to The Debt Doctor.
Appreciating to be here at the doctor's office, but I'm pretty healthy right now.
I was gonna say, if I'm a debt doctor, you're like the local pharmacist,
Oh, yeah.
always dealing out some sort of new drug or some opportunity, always there for people.
Old enough to do house calls.
I'm so excited for us to talk today because I get to introduce the world to, what I would call the Saturday Evening Post of the real estate loan business. You are a classy man. You've been around the business quite a while. When I look at your story, and it reminds me of the old days, classic days, where you're loyal to a firm, you stick around a business, you don't expect much, you kind of have, typical American dream life. Why do you think I would say that about you, David?
I'm going to say because you have seen me for the last probably 18, 20 years of the 30 years I've been, with SN servicing. And
that's right.
And again, I think we both really push the relationship side. We understand how important relationships are because, as I just said, you and I are going to have seen each other for 15, 20 years, and we'll be seeing each other for another 15, 20 years. And, that relationship will continue.
That's
Your
right.
business was built on relationships. Mine continues to be built and grows on relationships.
That's right. And that seems to be a little bit of a dying fad. Now, I would like to believe that there are some of us in the business world and in humanity who still think long-term like that. There's certainly cultures outside the U.S. that think beyond the quarterly reports. And I know there are folks like that in our business because I've met them. I kiss a lot of frogs. Once in a while, you meet a prince. So along those lines, I'll take a step back. By the way, if anybody is new to the Debt Doctor and you're just here because David Pollio dragged you in, please do subscribe. We are building a community of smart, interested people in the economics of real estate and the economics of debt. We're getting beyond real estate, especially there's a lot of conversations we've had about private credit in the last 60 days. But what's interesting is let's take us back to where you are, who you are, David. And I want to introduce you. I know that I've had you on webinars. I've had you on my previous podcast called the Real Estate Lowdown, which has some amazing episodes with us. And I would say you are an anomaly in the business. And you live in a beautiful place in the Northeast out on your own, away from the major cities. You work for a gentleman that owns one of the largest privately owned mortgage loan servicers, which is based in another middle of nowhere on the west coast of the U.S. And you guys have kind of flown under the radar, which I think is a good thing in the loan servicing business. Anything that has major regulatory oversight. But you also loan servicing, you really handle loan trading, loan sales. While many of your clients are larger institutional investors, and your own owner as well, you you also really cater to new investors, smaller investors. Like I say, you're a pharmacist because pharmacist is the guy that reminds me in the old days. I don't know if this still exists. Again, the guy, it was the local guy you could trust, who, when the doctor prescribes you something, and you go out and you're about to take it, and you're about to start this medicine or whatever it might be. It's the local pharmacist that really interprets what's going on, is there for you, holding your hand through the day to day. And I kind of think that's how you handle mortgage loans. Is that a good way to describe you?
Yeah, no. So I think we realized in the beginning that yes, our business absolutely needs the large hedge funds, the big whales, to really keep it running. But we also realize that, and we've seen many times where if we cater to small investors, we have seen the results where some of these small investors, whether they're buying one loan, they could have been buying one loan or two loans a year, have turned into some good mid-sized companies where, today, 5, 10 years later, they're buying 200 to 500 loans a year. And, that builds on the trading desk side. But of course, it's going to feed into the servicing side. We don't always push that we have to service the loans that we're selling. But I would say 70% of the time, we're able to take those clients that we're building on the buy side and add them to our servicing book. So we kind of realize that yes, the big guys, everyone needs the big guys to keep things running and um, to make your position in the market here. But time and time after time, we figured out that these small guys, they turn into mid-size, turn into to maybe one out of 30 more turn into a large size purchaser, which becomes a good client for us. So I think that's something that we've kind of kept doing for the last probably 15 years since we started the trading desk. And you talk about Rob, the owner of SN Servicing, and he's out in Eureka, California, and I'm here in Kennebunk, Maine, which I've been in the New England area for the last 30 years. And I always tell people that how many times do you think Rob has visited my office in 30 years? And the answer is zero. He's never been to any of my offices in 30 years. But he gives us that freedom and that ability, which kind of built a lot of things that we're doing right now, whether it's on the acquisition side, the trading side, and the servicing side, and um, getting into different avenues on the servicing and the acquisition side.
And SN has a long history even before you were around, actually. And I'm a big, I love perspective and people that have been through cycles and whatnot. Um, when I before the GFC, before 2008, which is the year that I got into buying mortgages, SN was probably more known as Security National, right? Which is what it stands for. But Security National was one of the investment groups that kind of got its hands cut in the cookie jar, so to speak, when with all the securitizations. And most of the companies either invest. You guys were investors, Rob, in his various funds that he managed, and servicers. And I would say that I can't even count on my hand the number of firms that were that heavily involved in the pre 2008 world that survived, basically, that are still around, that reinvented themselves really amazingly, because on the servicing side, compliance was key. And you're considered one of the more by the book, conservative compliance servicers in the business. And yet your book is growing. People are saying great things about you from an investor standpoint. No complaints on the consumer side that I'm aware of. How from your perspective, how did Rob accomplish that? How does your firm accomplish that?
Um, so yeah, they started in '87, and their first cycle was they actually started in Anchorage, Alaska. And so their collection office in Anchorage was directly across from where the regulators were closing banks and doing the first um, um, NPL portfolio sale. So he
So
was,
that was back in even before GFC. That was
yes,
RTC,
yeah, it was
Resolution
even
Trust Company.
little before, even before RTC, where Dallas
Right.
got the start. So
Wow.
he would walk across the road, buy the notes, walk back to the office, and start collecting. So that's
I
really
mean, I assume it's pretty cold, so you better run across the
yes, yeah,
road.
and a lot of the debt he had were fishing boats. Oh yeah, some
Really?
interesting, yeah, prop and a lot of resorts, fishing lodges, some interesting collateral, of
Talk
course.
about a real deadliest catch,
Yeah,
right?
and then you get into, like you said, the around 2008, and yeah, we were one of those firms that had some good size lines that were outstanding, based on all the purchasing and securitizations that we were doing. So we had to feed the monster, and as soon as that stopped, one of the things that Rob really made an effort to do was not to run away, and that was the key. No matter
Mm.
how tough it got for us, and it got tough for many years, whether we had to let a lot of employees go, turn the spigot off on buying any more assets, and getting demands all the time. But through it all, Rob really never ran away. He made sure that
Mm.
we liquidated, we moved assets, and took care of all of the debts that were part of the warehouse lines for us. And so,
It's an
yeah,
amazing show of integrity that does not really exist too much in humanity. I think that's what puts you out on an island and puts Rob out on an island as unique individuals. And listen, ours is not the first business that's full of slime balls, right? I mean, I was in the entertainment business for a period of time. You couldn't have gotten much lower than that in terms of the level of
right,
integrity that exists
right.
per capita. But it is quite a unique thing. It reminds me kind of, when people say, well, what makes you a good parent? Show up for your kids. You're not always going to get it right. They're certainly not going to get it right. And one of the greatest accomplishments you can do is if your kids believe that you're always there for them, physically, mentally, spiritually, whatever it is, that you always showed up. And that's a steady that's like the lighthouse, right? That's the steady light that's always calling you home.
Yeah, we
You
knew
know,
he wasn't going to go anywhere, so we were very confident in staying with him, and realizing that on his position too, it had to be pretty tough for 2 years every quarter, watching your net worth go down by 50 million every quarter. And so he was definitely watching that too, and realizing, what, I got to do what I got to do to get out of this.
yeah, you don't do it the right way. In other words, a guy in his position could have cut bait 2 quarters earlier, saved himself 100 million, probably would have, uh, you know, bankrupted the company. The people would have lost jobs. There would have been a lot of repercussions that he didn't want to see happen.
Yeah. And he
Well,
likes to
so
build, and he builds on technology right now. So the last 10 years, he's been really building on technology, and is really understanding that there's a cost to that. And so he's willing to take that cost, to get even like with AI and all this stuff right now. So he's really,
it's really interesting, and I know that you guys are working on a new. Jeff was telling me that you guys are working on launching a new servicing platform of your own.
yeah,
And I want to get more into that because technology is certainly on the minds of a lot of people, especially myself. Even though I'm getting up there in age, I've started to have some gray hairs and some loss of hair. I believe that what will make the difference for the next 10 years in terms of non-performing, sub-performing loans is anyone that can harness the knowledge that really hasn't been used for the last 15 years. The post GFC loss mitigation efforts. Prior to that, special asset groups at banks that existed to work out commercial loans or difficult situations. Entire area that no longer exists. I want to kind of get into I want to get because you've been around our business a while, you've got some perspective. There's probably things that you see different about the space than most out there because you have that perspective. Is there anything that comes to mind as far as like, a unique perspective on the business that maybe you might have different from the general, assumptions?
Yeah, one of the things that for the last, I'm going to say the last 5, 10 years that sticks out always to me is, this whole, we are bringing more new buyers into the arena here, which is great. I mean, that's what you need. But I think what's happening is that the people, and it could be yourself or even other groups that are teaching, which is great. They have the knowledge and they should be teaching these new people getting into the business with their expertise. I think what happens though is that if I know clearly if we were teaching, we would we would always be talking about 10, 15 years ago, we were working off of maybe a 30 to 55% yield on our NPL purchases, which it's easy to say that because we did do that, but I think the perception right now is that all of these new buyers for the last 5, 10 years think that return is still there.
Is the norm, yeah.
It is the norm, and it's not.
Right.
And I see a lot of new people coming in, a lot of people that have been on the sideline for so long, looking for that high teen yield, which even for our business and as buyers, we're not looking for that high teen yield anymore. We're looking to deploy the money to stay in the market. A lot of people stay out of the market for so long. They're not really reading what's going on over what the next cycle is going to be. And I always said that, if you're just buying one or two loans, just stay involved in the market. If you're not getting you thought you're going to get 18, but you got a 12% return, that's a win. You're
Yeah.
getting the knowledge, you're getting the understanding, and you're working through an asset. And you're not going to lose the money. You're not going to get the return that you expected. But again, you're in the market and you're getting that knowledge of holding an asset and working it through a servicing side. So I just wish people would just say, you know what, all right, let me put my yield to the side and let me work on buying for experience as itself.
Right. Man, you really did hit the nail on the head there, David. It's a double message because you and I have a tape out with you, and the differential between expectation of what these things should trade for and where the market is, where we have to pay just to buy them from HUD or from a banking entity is just way off the market. You're absolutely right. The 35 to 50% yield opportunities were gone in 11 years ago, to
Yeah.
2014, 2015.
Yeah.
That market was pretty much on its last. I mean, there were still deals to be had, but by the mid teens, the market had already bottomed out late 2012. There were still NPL buyers coming in. The real opportunity set was from 2000 to buy the deals that go down as like the stories that all the trainers now use, 20 cents on the dollar, 30 cents on the dollar. That was 2010. That was 2009. That was maybe 2011. And by the time you get into the middle teens, people are bidding to, where they have cheap cost of capital, leverage, note on no leverage became a thing. And all of a sudden, and then you had some big players coming in and eating up all the conventional stuff. So where I 100% agree, it's we rebid. We're lucky if we can get something in the teens on a yield, and we're happy with that. And I don't know if it's because people are so used to seeing, Bitcoin in the stock market, increase at exponential numbers, or they're making 20% in equities. what people haven't experienced as investors, the layman's especially, is really any kind of down market. You know, my father used to say anybody can make money in real estate when the wind is at your back.
Yeah. Yeah.
But what separates those from when the blood's on the streets, when the stock market continues to slide and people start running for other asset classes or some other event, black swan event comes across, it's those that have the wherewithal to really price and buy stuff in those times. That's where you're going to come back and say, oh man, those guys made 30-40% on their money. Yeah, but because they were the only one standing when everyone else was running away.
And it's
And
hard to
that's kind of
compare.
where we're at,
It's
right? Go ahead.
it's hard to compare bulk buyers like us to single buyers because we are so used to buying in bulk where we're going to have a good portion of the portfolio could be a complete zero, where the other part of the portfolio is hitting home runs, and we're still getting our required yield. But when you're buying one or two loans, I could see how that you could have bought that one where we thought it was zero.
Right. Yeah,
It's
and
hard
so
to.
there is that risk, for sure. And you're right. I think that there's more folks out there that are making money off of building the hype, and they're the trainers in the business. You and I have talked about this for years because I get people asking me, why aren't you doing training? And I probably would have more shekels in my pocket. But a lot of the guys and gals that are doing this training, as cynical as I will get, is to say, those that can't do, teach.
Right.
Now,
Yeah.
obviously, there's a couple of us that are in the business making a living and still finding time once or twice a week to share ourselves, either here in a venue like the Debt Doctor or on stage at an event, and we actually get some value out of it. If I had to do training as a career, I'd probably be like some of these got folks that are out there hyping up the value of buying notes because that's how I get you to pay me $1,000 or $10,000 to come listen to something I could learn through ChatGPT or by reading or by listening to our podcast. So it's a really interesting dynamic. It's got it, and you and I have seen this over the years. It's probably come back a little bit. I'm always careful not to hyperbolize the opportunity set that exists because for me, buying distressed or discounted mortgages, especially in first lien position, we can talk about. I'm going to get into some of the second lien conversation, some of where the market's going. We'll get into that in a second. Um, but if you're a first lien lender or a title holder of real estate, and you're buying that at a discount to the value of that real estate, even if we saw a major market crash in residential, real estate is like a slow moving ship. It doesn't crash 40% overnight. You still have areas where you can play inside of that. So if you're buying something at 65 or 70 cents of the real estate value, you have plenty of optionality. You have very little downside concern unless the property that goes uninsured and then gets, or you spend through, years in litigation or something else occurs. For the most part, this is a capital preservation investment first. So it's not investing in private credit that's lending to automobiles or to business cash flows. This is not investing in a stock where things have looked good for 15 years, but in 3 months the company could go bankrupt. There are plenty of assets, and that's what's happened with all this free money and all this long run of low interest rates. Is it's muddied the view of investors between what is really an asset backed investment and what is just speculation, playing at the blackjack table, and you happen to be on a good run for a number of years. And so for me, if my investors make 10 or 12% and I can deploy hundreds of millions or billions at that level unlevered, meaning I'm not taking any risk. I'm not putting our portfolio debt, but just to make a double digit return on an asset where you have very little downside, zero, almost zero risk of losing everything because you're diversified, you're backed by real estate, you're monitoring the book. To me, that's like the a no brainer. And it's not comparable because, and we can't sit here and compare it to even within our knowledge the last 10 years because everything has been going up. So it's like, it becomes like, oh, is it really that riskier to buy HEI investments from Blue Owl? I mean, look, they're making 20, we're making 20% doing it. Well, there's a reason why that is yielding 20% because is it really as secure when the lights go off?
Yeah, and you've created that relationship with your investors, where as soon as things, well, when something does move in your favor, you've already have those guys lined up, and it's not like you need to recreate the wheel because they've seen you do it with the getting whether the 10, 12% yield, where now your story was a lot more exciting, knowing that the market is going to be in your favor. So
Yeah.
you might just be doing that. I'm never say it's break even, because you're getting the knowledge, you're getting the relationships, you're moving forward on your business. And so that part alone to me has value.
Yeah, 100%. Yeah, I agree with you. When I do speak at some of these events and know the audience is a newer audience or an audience that's there kind of learning the business, so to speak, for educational purposes rather than for simply for connections. The one thing I'll always say is you got to get on the court and off the sidelines, out of the stands, and start playing. It amazes me when I see folks that are spending thousands of dollars, 10,000, 15,000, 5,000 to attend these events. 3 or 4 years later, they're still going to the events. They've spent
Yeah.
50 or 100 grand
Right.
and they haven't bought one asset.
Yeah. Right.
You think about, I mean, you can get there's a lot more to be learned from diving in and jumping in the water.
Yeah. I mean, I always, that's probably not the best example, but stocks. I I buy stocks that, when they lose money, it becomes more of an education for me. And I, take it out and move into something else. And so,
That sounds like me. I'm always getting an education,
yeah,
investing in
yeah. Listen, it's, it's,
all the more reason why, by the way, I never lose money on my real estate investments. I've always had a great eye for that. You'll end up like you said. You'll buy a pool of mortgages. If you're not necessarily expecting to win on everyone, so that's fine. But if I pick a stock and I want everyone to know, if I make a recommendation on a stock, do the opposite.
do the opposite, right? Take you short.
Exactly. Bill's recommendations: short Bill, and you're fine. So
Well,
let's
that's, I
talk
mean,
about other.
I think your real estate background clearly helped you to diversify it into the Heckams. I mean,
Right.
that's really where a cycle has moved you into a different part of the market now, where you might not you're looking for NPLs, but if that NPL is drying up for you, you then go to your Heckham deals, which you've been very successful on. I mean, that's
Yeah, that's
unbelievable. And
that's
that
true.
may change in 10 years. Who knows?
Are you kidding? It's going to change in 2 to 3 years. I mean,
Yeah.
eventually, I don't think that this strategy will get flooded. Right now, HUD and the U.S. government is sitting on about 15,000 home backlog that they became aware of about 18 months ago. Started packaging these loans together. These are these Heckhams where the reverse mortgage, what I call the Tom Selleck mortgage. Borrower has now deceased. The borrower's spouse is deceased. Property is either vacant or an heir is living in it. And a lot of people don't realize what happens during that. So the federal government's not in the business of foreclosing. It's just HUD hasn't done that in years. That's
Or
why they came
managing
up with
properties. Yeah.
yeah, they can't. There's too many. Who's going to do it? They actually have. It's a fun fact that the U.S. Department of Housing Urban Development has a contract retainer with the Department of Justice to do their foreclosures
Closures.
for a flat rate of $500,000 per year. How many mortgage foreclosures do you think DOJ actually did last year? It wasn't enough. It was way overpriced per
Right.
file. DOJ has bigger fish to fry than worry about foreclosing on anyone. So, and that's where the FHA partial claim program came about years ago, and then this HUD HECM sale program where the U.S. government, us as the taxpayer, owns these mortgages now. We've paid the insurance to the bank. Mortgages are underwater. Properties are vacant, or maybe there is an heir living in there. It's just now we got to effectuate getting title from HUD's mortgage assignment. They assign the mortgage to us as an investor. We go out and it's a fix and flip trade, but before you can fix it and flip it, you got to get title. So it's get title, fix, flip. Now, getting title when the borrowers are deceased is a whole different game than when, we've done it in the past. When you read
Right.
my book,
Yeah.
Win-Win Revolution, Dean Liu is like the number one thing. So, but now you got to get that from the estate or from the heirs, and you can't always legally and technically do it. So you're right. You have to be nimble. If you have a background, we've done many strategies over the years. And there was early on, there was a strategy to focus on certain regions of the country. And in the beginning, for a bulk of my career buying non-performing, the strategy was very simple. And we can't even do this right now. The strategy was people are upside down. The market has dropped in value. We're buying the debt at a discount to even where market is today, which gives us the opportunity to really be the savior to everyone, meaning the borrowers, the communities, the lenders that we're providing liquidity to, and the most common thing that we did, which I say cannot happen today, is we modified. These were 6 and 7% mortgages that were done against property values that were incorrect or that reset over about a 2-3 year period from 2008 to 2012 ish. And so if I could go out and buy a $300,000 mortgage at 7% interest, the property's worth 200 now, and I can buy that mortgage at 120,000, let's say. I can go to that borrower and say, I'm going to reset your mortgage to 5,000. I'm going to put you in an equity position day one. If you make your 6 months of payments, you season my loan. Now I'm going to forgive that 105 of negative debt. Literally forgive it. Aquin wasn't doing this. The others weren't doing it. They were just creating phantom seconds, which was we're going to get into in a second. And then I am going to keep you in that home, and I'm going to lower your interest rate in order to do it. I'm going to lower you to 5%. The issue today now, that scenario doesn't exist. More than 60% of mortgaged residential properties have below a 4% interest rate. So we have a long way to go to where us coming in as an investor can actually move the needle. If somebody's not able to perform on their 3% mortgage, there's not much options for them. They got to sell that property, hope there's some equity, and move on with their life. Optionality has decreased. And then you've got a lot more. This is where I kind of want to get into your perspective on, prevailing views in the industry and where might you see things differently. I want to get into housing equity investments and seconds in a second. But before I do, is there a prevailing perspective that you see? Like, I love, me, I love finding fallacies. Where is the paradigm of society different from what I believe it should be? Anything along those lines that you've been thinking about recently is where, man, I really see the industry differently than most people.
You're getting really philosophical here. I mean, I think it's more of what I think is going to happen. I
Oh, yeah.
think there's going
Let's
to
get into
be,
that.
yeah, I think there's going to be a lot more, and I'm seeing it now, a lot more mid-sized funds that have been doing this for 5 to 10 years, that are now they're getting out. I'm getting more funds coming to the trading desk saying, "Listen, we've got these three funds, and these three funds have 20, 30 different assets in the fund, and we just want to liquidate and move on. Now, are they moving on to something else, or are they trying to build the coffers for something they see coming in the future, which I'm not a strong believer in that right now. I don't think that,
Right.
the values are just way too high and interest rates will come down. Um, and
So
like
you're
you mentioned,
saying folks are just probably, in more cases than not, you've had folks trying to enter our business or who have been in our business as a mid-sized player for a number of years and just haven't been able to build the volume or make the profits. And some of them are even maybe ready to cut bait and move
yeah,
out of the industry.
yep, they can't deploy funds, so they're gonna liquidate what they have, and realize that they can't build on it. They don't have the they're not buying the portfolios or the type of assets they were for the last few years. Um, and you also I'm starting to see some of the larger funds, where, if you sent them a pool of 20 or 100 loans, they would say, no, I need something that's around 500 assets or greater for me to analyze and spend the manpower on this, where they're now buying pools of 20 assets and lower, which is interesting. So
Hmm.
they're deploying more into that smaller side, which, of course, as a new investor, that doesn't help you, because these guys have, as you said, a lower cost of
Now you
capital.
got the real money coming in and
Yeah,
eking you out, playing competition. Yeah. In many ways, that was the one saving grace to being a small time individual investor is that, and that's an area where we played, was we being willing to pick up smaller pools or individual loans for so many years. But even the big boys are now reaching down into our pool and overpaying or being in competition, even if their deal matches ours, or even if their deal is a little bit lower than the one-off investor, their reputation
right.
usually will get them that deal, right? So
Yeah, yeah.
more squeeze for the small time guy and gal.
And we're also seeing a kick up in seller finance. Seller finance paying first lien loans. Now they're in certain areas. Most of the ones I'm seeing are in Texas, but they're trading in the low 80s. You're looking at around 6 to 6.5 rates. LTVs are pretty good. I mean, are they below 80%? Some of them are, but you're probably average about 85 to 90%. But they're showing at least 6 to 12 months, 18 months of consistent pay histories, and they are liquidating these around 80. I'm going to say 82, but low 80s, low 80s,
Wow.
which is interesting. It's like, you're looking at stuff that was originated, and the originator probably made about 2 or 3 points on the deal, and they're moving those off the line at a pretty good
They're
discount.
taking significant losses to principal just to move that off the line. Even these are even performing loans, you're saying.
Yes,
Seasoned
yeah,
performing, no
yeah.
sign of anything. Is that so? How does the seller justify that? Do you think that's a canary in the coal mine? What's the thought process there?
I don't know the exact thought process because it's fairly new, last 6 months. So I don't think they're going to basically say, hey, here's the reason why we're doing this, because we're in trouble. A lot of them will say, well, I need to do this because I'm so busy on the origination side. I need to keep moving in and out of the line. We've actually been buying it ourselves because we like to sit on it for the cash flow. When
Yeah,
at that point, we're not looking at the yield, because the yield is not going to be anything probably above a 12% yield. But we're looking for cash flow on those type of portfolio purchases. you know
interesting.
every once in a while we could put a few of those out, where if someone's doing a self-directed IRA purchase, they're going to pay probably in the 90s for that, and be
You know
happy with
what?
anything above an 8% return.
How do you guys manage that world? I mean, as Rob being one of the few servicers, not one of the few, most servicers also invest, right? They have, but a lot of times they're buying MSRs or they're buying, or they're building their own book of originations and selling off some of that stuff. How do you ever run into issues where, folks are like, well, you're our servicer and you're competing against us to buy loans or anything like that? How do you guys manage that? Because I had a special servicer tell me the other day that if I were to buy him, he would lose some of his clientele because his clientele are other competitors of mine. I just don't know if that's true. How you navigate the world of being a special servicer and a broker trader for the entire industry while still also picking stuff off as an investor. I need
Yeah.
some advice there.
Well, I mean, the purchases are direct relationships. So it's not a relationship where they're asking me, "Hey, can you go out on the trading desk and put it out to the market, and I need to do a competitive market analysis and take in the bids and then make a decision there." Anything that hits the trading desk, we don't put a we do not put a price on that. The
Got
only
it.
time the only time that we would do that is if no one bid on anything and they came back to us and said, "Listen, we need to move these assets." Then I would say, "Listen, I'll look at it for our own fund, and here's where we would be on that
Right.
type of purchase." But
So you
we
keep
don't
like
mix.
this got you keep a wall between it
We
where
do.
if somebody comes to you wanting open market bids, you're not going to bid it. You're
No,
going to put it on the trading desk. You'll be there as a last resort if the seller doesn't like any of the bids and you're willing to pay more,
that is
or if
correct.
there is no bids. So that's
Correct.
kind of the way to do it. By the way, that's kind of how I've been pitching it to my servicing clients, my special servicing clients is if we can't fix this loan, we'll buy it. We're always your
Right.
backstop.
Yep.
We're not going to be the best bid, but
Yep.
we're there in case you need us down the road. And so I think
And it's
that's
a
the real,
reliable bid. You
yeah.
know.
And a lot of people, the word fiduciary doesn't mean anything to them or they don't understand. I think you and I come from a little bit of that old school mentality where, we get what that's all about, and that's more important for guys with
Yeah.
longevity in the business.
Yeah.
I want to switch to because we've been here almost 45 minutes. We could talk for hours, you and I know. And we also both have day jobs we got to get back to. We're here in December, end of 2025. This is one of our Christmas special episodes or Hanukkah and Kwanzaa depending upon where you go. And so it's kind of a little bit of a year in review. I can't believe how quick the year has gone. And it's also, we're not gonna finish this without some bold prediction. We'll get to that in a minute. I want to switch to something that's just in the last couple months has hit the headlines for our industry in a big way. Bloomberg has caught on to what they're calling the zombie mortgage crisis. Second mortgages owned by friends of ours in the business. I've never been a second mortgage player, and maybe this is now the reason why I'm glad I stayed out of it. But Bloomberg has done a series of articles around people that are friends of ours that we know that are investors that are good guys that are kind of maybe getting their fingers caught in the cookie jar a bit, but not doing anything illegal, right? They're just playing into a system that exists. Um, and let me set the stage for it for those that haven't really been following the news. Then they can go back and hear our perspective on it, and then go back and maybe do some research and keep an eye on this space. But basically, the long story short is, and some of our friends were a little bit open to it when NPR did the money podcast where Dave was interviewed. This was
Okay.
like
Yeah.
9 months ago, and that kind of
Right.
opened the door. And then he kept answering the phone for Bloomberg, and now I think he's kind of shut the
Right.
shut down as the articles have gotten bigger in scope. I
Right.
literally had a Bloomberg original short film pop up on my YouTube this morning about this topic. The story is that folks, when the mortgage when real estate dropped dramatically in value post 2008, the value of these first mortgages completely overshadowed the value of the real estate. So that means that if there were second mortgages, which a lot of people were buying, were getting 80/20s or 90/10 in order to do 100% financing. If there was a second mortgage in those mortgages from pre-GFC, those got written off to zero. I mean, from day one, in the sense that the banks did it, they would even, in many cases, send debt forgiveness letters, 1099s, back in 2009 or whatnot. So that's what you call charged off debt. The bank, the lenders charge that debt off. It doesn't make the lien
Would you
go
consider
away.
that a hope note? Would you call those hope notes when they first originated them?
Well, some portion of them were certainly hope notes, and then what ended up happening was you had is immediate fixes in the early days, 2009, 2010. You would have somebody come in even with just a first and separate it out into a first and second, whereas we would forgive that remaining balance.
Right.
Some would say, okay, you owe us 300, property's worth 200. We're going to separate this into a first and second. The second is going to be no payments necessary, but it will accrue, or it's 0%, it'll just sit there, whatever it might be. It's still a second lien. In many cases, these were just second mortgages that were used to originate to spread the gap to make it 100% financing or 95% financing. It was 75%, 80% first, 15, 20% second. And so the major banks were giving all these out as part of the crazy financing pre-GFC. So when all those went bad, those things became like charged off credit card debt. And was charged off credit card debt, it sells for 5, 7,
Pennies. Yeah.
10 cents on the dollar.
Yeah.
Doesn't mean you're not getting the phone calls. It does mean that 95% of the debtors are probably they're insolvent. They've already ruined their credit. You can go after them for personal judgments. Maybe you'll collect. But, most people that get into that game, it's a bottom feeder's game. And they figure, okay, well, worst case scenario, we pay 10%. If we collect 15 or 20% of the back, it's a home run for us, right? Okay, so what's interesting about these seconds buyers, and this went on into the middle teens, and even into the late teens, where there were these underwater seconds that were charged off, but these were still second liens on the real estate. So certain folks have gone out and over the years collected, and some of them going way back to GFC, and some of them in the later teens as a newer strategy. But they went out and bought these pools of seconds for 5 or 10 cents on the dollar, and some of those properties, the mortgages were modified in first position. The real estate has obviously doubled, tripled in value since in the last 10 years. All of a sudden, what looked like an underwater mortgage that was uncollectible, against zero equity, now there was equity in the property. And so for a portion of these mortgages, these investors have been able to go back and send out claims and basically renew a claim in the equity position. Now, this could obviously appear as something out of the blue and very unfortunate for someone who, thought that they had gotten through the GFC, they modified, they kept their first in order, they got that all, and then all of a sudden they get hit with $100,000 second because that $40,000 second that was sitting there, which they thought was charged off, now the new owner of that debt, this private equity firm, is saying, no, it's been there. We just are coming to collect now. And obviously this has caused some panic, and it's got a lot of the consumer advocates jumping at the rafters. Bloomberg has done two-part series in writing, and is done now starting to do video originals about it. And they're pointing out to a couple of folks that we know in the business who are good guys, but just doing their job. Maybe it's unfair, but seems to be legal what they're doing. There's class action suits now starting. That just happened with one of our servicing friends. I don't think you guys got wrapped up in that one, did you?
No.
That just goes to show. What are your thoughts on that whole second mortgage? What everything that's going on around?
Well, do you think, I mean, I guess my question is, do you think Bloomberg is making a story because they're looking for legislations to start on this? Do you think that they're looking for the courts to make a decision on whether someone can rack up accrued interest on a loan that was charged off? Is there statute of limitation issues?
That certainly is an argument. There
Yeah, I
are
mean,
folks in various states, depending upon the state, there are folks that have there are definitely some mistakes being made in the way that the investor is kind of coming after them, claiming interest for 10 years when maybe the state law only allowed them 7. Now, if nobody's there to contest it, and most individual people are not sophisticated enough when it comes to debt, which is why they need the debt doctor and the local pharmacist. And when it comes to debt, it's an area where we all get a little afraid, you know? And maybe in a previous life, 3 generations ago, maybe I was in a debtor's prison or something previous. But
right.
it's something inherent about it that really it bothers us. It's the reason why when you're 28 days late for your credit card payment and the credit card company starts calling you, you don't pick up the phone. There's something about that.
I think there
Um,
is a recovery for the investor that did buy it back then and continue to service it the way it should be serviced. I kind of believe that if they're willing to move forward on a second lien foreclosure, spend the time and money on doing that, and they've done it, legally, and they've serviced it properly, I believe there's a return there for the investor.
I agree.
But there's a fine line of someone just saying, I had this in White Mountain file cabinet for 20 years, and now I'm just taking it out and realizing that you have equity in your home. We're going after the full debt
Right.
plus the 10
Yeah, and
years.
I think that's where morals and
Yeah, I mean,
having a clear conscience, where there's ways of dealing with it, and I think that I'm sure that these are outlier stories that are being
yeah,
called out. I mean, for every one of the ones where they had a legitimate claim and made an attempt, and unfortunately had to take a home or force a foreclosure, I'm sure there were plenty of times where they got people reperforming, and there were plenty of times where they had to walk away from stuff. So it is a little bit of a mixed bag. I was interested to hear your take on it. What about home equity investments? There's to me, if I can't understand it, then there's something wrong, right?
right.
And you've had some of these come and go, these companies that have come and gone where they're trying to do, where the properties are being sold from to the entity, and then the owners renting back in. That's what they call a home equity investment. Blue Owl is big in this stuff. Um, do you do you see that as an area that, I mean, I certainly would never buy a derivative that was based on a second, even if there was a ton of equity above the
Yeah,
property,
yeah.
because if the SHIT hits the fan, who's going to unwind that? Do you think the executives sitting managing a $10 billion book at Blue Owl know how to work out distress situations? It's fine when everybody's paying, but what happens when you actually have to work that stuff out and unwind it?
Yeah, I mean, that's a product that I know we don't service it. I know we don't buy it. I know we don't even trade it. So I think we're lucky to be naive and just say, it's we don't know anything about that, which is probably it's probably good for us.
That's
Because
probably that's
the
right. In
more
the
we know
long
about
run,
a
you're
product, the more we want to buy it. So I think it's good that we do not know. I mean, the one thing that we've been pushed to look at in the last 6 months is the DPA loans, the DPA second liens, where they're actually the deposit loans on the large, I think they're FHA loans,
right,
where they're 5 to 10% of which is the deposit,
right.
and these guys are originating those so quickly these days that, again, like the seller finance on the pricing, they're willing to sell loans that had been originated 6, 12 months ago that are performing, constantly paying for 60 cents on the dollar.
Wow.
You're buying a performing second lien that has 100 to 110% LTV.
Wow.
which
You're buying, yeah, with the and but you're buying it at a discount because those guys know that there's a very high chance of
very high chance. If you're showing a transaction that is performing 12 months of consistent pay history, I think the rates are, I think they're pretty competitive. I think they're between 7 and 10%. I think 10 would be kind of high. Um, I think around 7.5. But as you said, if you think the market valuations are going to start dropping, anywhere, I mean, probably anywhere of a 20 to 30% drop, then you're back in the same situation where these are now zero equity.
right.
Actually, they kind of started off as zero equity loans.
Right, they were
You know,
already negative to begin
yeah,
with.
they're
If
only
it
negative
was
to
something that
start
was
with.
originated
Yeah.
2 years ago at the top of the market, we've seen 30% pullback in some markets already. It's crazy. Well, anyways, David, it's been great spending this hour. I want one more bold prediction for the future. I always ask it. Where do you see the future? It could be fake. You make something up. If you want to pretend like this is a comedy show and just make something, you could do that. Or you could be seriously, where do you think in 2026, what's something we're not seeing that you think will happen in the near term?
I'm going to go back to the mid-size funds. I think the ones that are listening to this have relationships with so many of each other, within your own business area here, that I think you should be reaching out to them and seeing if their idea is to move their assets off their line right now. If they're looking to
Mm,
close their fund, your relationship with them through all these things that we've done, note schools and podcasts, different conferences, I would make a big effort to reach out to them, and see where you can deploy your funds, where they're going to be needed for them.
Very good advice. I am surprised by the number of my competitors. I guess I shouldn't be surprised. It's not an easy business to make money in if you're a small fry. And while our investors are happy with us as managers of these funds, it becomes very difficult when there's not product out there. So I agree. You're going to see consolidation within the industry. You see a lot of folks that are just white knuckled it. They thought COVID was going to bring the opportunity. That didn't come. Then 23 interest rates was going to be the opportunity. That hasn't yet come. And for those that there's some portion that are not going to, just like in the banking industry, in the private equity industry, those that don't have the capacity or the patience, I'm seeing consolidation. I'm seeing companies really ready to kind of throw up their hands and move on. Dave, I think it's a great prediction. I'm in agreement with you.
Yeah.
Have a wonderful holiday. Hey, if
You also.
people want to reach out to you that are new investors, want to learn about buying notes, first, seconds, the note trading business, you are the original guru. I'll call you the SOT guru of small balance loan resi trading.
Got it.
They'll know where to find you from the description in our conversation. Any quick uh, comments on where to reach out to you?
Well, I would always start at the company website, which is pretty simple. It's just snsc.com. And at least with that website, you can kind of get a feel for what we offer on the servicing side, how you can be part of the trading desk. It'll take you to an investor site, and it's just an NDA that once we have that signed, we get it within seconds, and we put anyone that signs the NDA onto the distribution list. And so, anytime and every time that we have anything for sale, that investor will have the ability to review the same tape as everybody else does. And I would think on the website it has my direct cell number. But if you ever need to ask a question about what you're seeing that's not on our trading desk, we love to give advice. And if you're little
And if you're dumb
curious,
enough to take it, then good for you.
and if you're curious about who you're dealing with, let us know. We've been around so
No,
long that
you are a wealth of advice. I always tell people who are serious about the business or wanting to learn more or get in their foot in the door that getting with David Pollio and the SN Group is a great starting place. There's a lot of folks out there selling chicanery, and don't have the perspective you do. You're a valuable resource to the industry. I acknowledge you for that. I acknowledge you for being willing to put up with all of this, the newbies in the business. There are not many that have the level of patience. I guess that comes from living out in the middle of Maine where, you don't. That's right. That's right. You put up with enough already. You now have patience. That's where patience and wisdom comes from.
Well, enjoy your
David, it's great
birthday.
hanging with you.
Enjoy
What's
your
that? Oh,
birthday.
yes. Thank you so much. The big
Yeah.
50 is coming up this week, or
Woo.
next week.
Mine will be the big 60.
We still got some years on us.
Oh yeah.
And we still got another cycle. So
Oh yeah.
it's great being with you, Dave.
Thank
Thanks for
you.
joining the Debt Doctor.
Appreciate it.
That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.